Most people have more money today, but significantly fewer things to show for it. This is the core of the purchasing power paradox, a financial phenomenon where rising nominal wages mask a steady decline in actual standard of living. While bank balances may show more zeros than in previous decades, the ability of those dollars to acquire real-world assets has been systematically eroded by the invisible hand of monetary expansion. Understanding this paradox is the difference between those who merely work for currency and those who build lasting wealth. Over the next few minutes, the data will reveal why a six-figure salary no longer guarantees a middle-class lifestyle and how the global economy has fundamentally changed the way value is measured and stored. In 1970, the median household income in the United States was approximately $9,800 per year. At first glance, this figure seems incredibly low by modern standards, yet it allowed a single earner to support a family, own a home, and maintain a consistent savings rate of nearly 12%. By 2023, that median income had risen to over $74,000, a numerical increase of more than 600%. However, the cost of the primary pillars of the American dream, housing, healthcare, and higher education, has outpaced this wage growth by a staggering margin of nearly 3-to-1 in some metropolitan areas. In 1970, the average home cost roughly $24,000, or roughly 2.5 times the annual median income. Today, with the average home price exceeding $400,000, a median earner must spend over 5 times their annual salary to achieve the same milestone of property ownership. This discrepancy reveals the trap of nominal growth. People are earning more units of currency, but those units have lost their density. When the price of a gallon of milk or a new vehicle rises faster than the rate of a paycheck increase, the individual is effectively experiencing a silent pay cut while the numbers on their screen suggest they are moving forward. The data from the Bureau of Labor Statistics confirms that when adjusted for inflation, the real purchasing power of the average hourly wage has remained nearly flat for the last 40 years, despite the massive technological advancements and productivity gains of the digital age. The paradox deepens when examining the difference between consumer price inflation and asset price inflation. Central banks typically focus on the Consumer Price Index, or CPI, which tracks the price of common goods like electronics, clothing, and food, often showing relatively stable or low growth. While a television might cost 50% less today than it did 20 years ago, the price of the stocks, bonds, and real estate needed to fund a retirement has exploded. This creates a psychological diversion where consumers feel wealthy because gadgets are cheap, while they fall behind on the assets that actually build long-term security. From 2010 to 2020, the S&P 500 returned nearly 14% annually on average, far exceeding the reported 2% inflation rate. For those who already owned assets, this was a decade of unprecedented prosperity. For those attempting to save their way into the market using only their wages, the hurdle became exponentially higher. The Cantillon Effect explains this phenomenon, suggesting that those closest to the source of new money, large financial institutions and asset owners, benefit first before the currency devalues. By the time the increased money supply reaches the average consumer, the prices of the most desirable goods and investments have already adjusted upward. This leads to a society where the wealthy are not necessarily those who work the most hours, but those who move their currency into hard assets early. The purchasing power paradox proves that holding cash is often a losing strategy, as the very measurement of its value is rigged against the saver over long time horizons. To truly understand the erosion of purchasing power, one must look at the M2 money supply, which represents the total amount of currency circulating in the economy. Since the global financial crisis of 2008, the amount of US dollars in existence has increased from 8 trillion to over 20 trillion. When a supply of money increases by double digits, while the production of goods and services grows at a mere 2 or 3%, the math is inescapable. Each individual dollar becomes a smaller claim on the total economic pie, leading to the inevitable rise in prices across the board. This is often referred to by economists as monetary debasement. Historically, empires from Rome to the British sought to fund their expenditures by reducing the silver or gold content of their coins, allowing them to spend more without officially raising taxes on their citizens. In the modern digital age, this process is much cleaner but far more efficient. It occurs through the expansion of central bank balance sheets and the issuance of government debt. The cost is not paid in a lump sum, but through a gradual, persistent loss of what a dollar can buy at the grocery store or the gas station. The paradox remains that while the government reports low inflation, the average citizen feels a much tighter squeeze. This is because the items that are easiest to manufacture, like software and clothing, remain cheap, while the things that are difficult to create, like land and high-quality services, absorb the excess liquidity. Studies show that for an individual to maintain the same relative economic position as a median earner in 1970, they would need to earn nearly double the current inflation-adjusted median today. This quality of life gap is the true cost of currency debasement that most traditional metrics fail to capture. If nominal dollars are an unreliable yardstick for wealth, then how should a prudent individual measure their progress? Wealthy families and institutional investors often look at their real rate of return, which is the interest or growth they earn minus the true rate of inflation. Another powerful metric is labor hours. In 1960, it took the average worker roughly 40 hours of labor to pay for 1 month of rent. Today, in many major cities, that same month of rent requires over 80 hours of labor, effectively doubling the time cost of basic shelter. To combat the purchasing power paradox, the focus must shift from accumulating currency to acquiring productive assets. These are things that retain value because they have utility or scarcity, such as well-located real estate, ownership in profitable businesses, or commodities with limited supply. History shows that over 50-year periods, fiat currencies tend to lose over 90% of their value, whereas assets like gold or equity in innovative companies have historically preserved their purchasing power by adjusting their prices to reflect the new monetary reality. By viewing wealth as the ability to command goods and services rather than a specific number in a bank account, an individual can make more informed decisions about where to store their labor. The goal is to own the things that the inflated currency will eventually flow into. The purchasing power paradox is only a trap for those who do not recognize it. For those who understand that the value of money is fluid while the value of assets and time is fixed, the path to financial resilience becomes much clearer. The most important takeaway is that true wealth is not measured by how much currency one has, but by how much of the world that currency can actually buy. If this breakdown changed how the global economy is viewed, the next video explores the mechanics of the modern debt cycle and how it drives the markets.